Okay.
What's going on?
What's going on, Mendel?
What's up, Naftali? It's nice to formally meet you.
Yeah, likewise.
Baruch Hashem.
Yeah, did Duvid, did he, we spoke about it earlier. Did he speak to them today?
Yeah. He should be signing on shortly.
Okay.
Just make
sounds
sure.
good.
You hear me loud and clear?
Yeah, you're good.
Nice.
My end's good.
Yeah, we're golden.
So I see you're recording. Is it possible when you're done to send a copy? That way, if like I missed something or want to go over.
Yeah, for sure. Absolutely, we'll do that.
Awesome.
We'll
Sounds
record it.
good.
We have a few people who are joining tomorrow.
Oh, very nice.
Some not yet. Some just Bichlal want to have it via recording.
I hope I helped push a little bit, make it happen.
You absolutely did. You and Dave were the driving force.
I was amazing. Okay, sounds good.
What's up, Gerv? How you doing? Waiting for a few more. I sent it to Strolik. I think he said he was signing on.
Is everyone in this course, is everyone from New Haven, Connecticut?
No, not everyone. A
Okay.
vast majority.
Okay.
Dov Vogel's not. Dov Vogel, what's up? There you go.
Oh, nice to meet you.
Yeah. So
Hey, how are you?
We have some Crown Heights. We have some New Haven. Let's say good vast majority is New Haven. We'll wait another minute to, it's 7:30. We just started. So I think we'll try. Maybe we'll do questions. We'll try to do like the chat box and whatnot, but we'll see how it goes. It might have to unmute every so often.
Okay.
So I'll tell you, what's your story? You just moved to town?
I'm a year in. And yeah, so far so good.
Nice, bro.
Yeah, have a brokerage firm.
Where do you live? Westville?
I live in Westville. Yeah, we just bought a house about a week ago.
Wow, good for you.
It's official. Now we're residents.
There you go. That's awesome. Westville's sick. Gerv, it's Gerv's wet dream, Westville.
Yeah. One day, graduate from Beaver Hills, make it to Westville, you know?
Yeah, 100%.
We can make that happen, by the way. If you dream hard enough, we can make it happen.
Just got to pull the trigger at some point.
Are you thinking about moving?
Huh?
You're thinking about moving or no?
I mean, Westville's always on the radar. Something on the outskirts of Beaver Hills is always nice. Like,
okay.
Right now I'm on like Ellsworth and like I want like a little less in it, if you know what I mean.
Okay.
A little more privacy would be primo.
I hear you. Yeah.
Naftali, do you do Mandy's Bridgeport listings or?
I did. I unfortunately had to stop. It just wasn't worth the time.
Fair.
Yeah.
Fair.
Yeah.
Sounds fair. I was giving this share by Zal, and it's interesting. You start gauging right away what people know, what they don't know. Over there, I had to tell them what a mortgage was. I had to tell them that you go to a bank and you get a loan on something. I guess we'll gauge pretty quick where everyone's holding here, but I think most people have like a real estate background. Whether you're an agent or you're doing construction or hell, maybe you're putting deals together. So we'll see. We'll take it slow. We'll make sure everyone's on the same page, and we'll do one step at a time.
Okay.
We'll learn the sprach for a little bit. Let me see. Who are we waiting on? Anyone else?
David said he's trying to log on.
Come on.
I see David. 1, 2.
Hello.
Dave, we hear you. We hear you, baby. All right. Nice. And Tella, welcome aboard. All right. So let's do this. All right, let me share my screen with you fellas. Did you guys all get the spreadsheet as well?
Yeah.
Yeah.
Yeah, everyone was able to make a copy of it. It would probably be Kedai if you follow along in the spreadsheet, so you could do, whatever we do, you do it on your own also. So then, you can't compare if you did something to if you just watched it. But if you don't have the double screen, or if it's going to be too annoying, then just follow along. Just share this bad boy. All right. You guys see the screen?
Yep.
So what I want to do is, you guys all saw me blasting around images of this spreadsheet.
Yep.
So what I want everyone to come out knowing is to basically be able to take a deal, whether it's 6 units like we have over here, or whether it's, a couple of 100 units. It's the same idea behind it. You have the same numbers that you're running. Obviously requires a lot more digging, a lot more due diligence on a bigger property because there's just more money at risk. There's more variables, but for the most part, you go through this, you could then go and break down any other deal. And this is very extensive. I don't know if you guys saw on bottom over here, there's all these tabs. You have the scenario, and then you have the summary and the P&L, acquisition costs, different exit strategies. You can calculate the returns. They're not happy with us because the returns are minus 220%, but we'll hopefully fix that soon. You have the returns, IRR, which some people love and hate. We'll try to explain it. It's a little philosophical. I don't know. I like it. Some people don't like it. And then whatever, once you go through that, I think you're good to go. Now to complement this spreadsheet, I also put together a PowerPoint. It was a lot of fun, actually. I enjoyed it immensely. So let me know if you guys see it. Let me do this. I'm gonna log on myself. So I'm gonna see on my phone in real time exactly where the spreadsheet's holding, because sometimes it glitches out or goes a little bit slower. Okay, I'm on. Look at this little baby screen. All right. So everybody, welcome to the Real Estate Deal Analyzer. Yay. No, that's the wrong way. Then someone read it out loud for the ILM, because otherwise it's just awkward. Gerv, I'm volunteering you to read it out loud to the ILM.
Okay, house hunters. All righty. In it, but the walls are. So are the floors, ceiling, beds, chair, and TV.
Very good.
Etsy sample written all over the place. And
Okay.
our friendly
now-
Flintstones.
Yeah, exactly. So
Good talk.
why real estate? We want to know why real estate over any other asset, over stocks, bonds, over gold. I know Tella here loves gold. So obviously, because it's fucking badass. But if you carry on, these are 10 real reasons that there's actual real benefits to real estate over any other asset. So one, you control the asset. It's not like a stock where you have Elon Musk putting out a tweet and all of a sudden it goes up and down. It's not crypto. You control it. It's up to you if the asset succeeds or fails. Long-term appreciation, as that's most investing things should have this, that it just appreciates over time. Depreciation is where you get to depreciate the asset. So if you have a building and you have income coming in from the building or from any other sources, you can then depreciate some of the income because of the building's wear and tear. Okay. That's called depreciation. Every year, it's a very specific formula. You don't get to keep it eventually. You have to pay it back, like I believe when you sell. But year over year, it actually helps with some tax, for some tax purposes. And that's a big reason why people get into real estate in the first place. You have people who are in Amazon businesses. I guess you asked Dave Wintel about this. You're in Amazon. And if you have a house, even if it made you money, you cannot depreciate some of that income. All right. Number 4, you could leverage. You have OPM, which stands for other people's money. So when you're buying stocks, crypto, when you're buying all these things, unless you're opening up a whole hedge firm, a whole brokerage, essentially you're limited. Here, you could leverage A, the banks, and B, you could leverage other people's money through investors. So what does it mean, leveraging through the banks? You put down 25%, and all of a sudden you can buy an asset that's worth 4 times that. So you have 100 grand in your bank account. All of a sudden, you essentially own something that's 400 grand. If that thing goes up 10%, you just made 40K. So even on the whole asset, that's only going up 10%, but on your investment of 100 grand, that's 40%. That's amazing. So you really get to leverage the power of banks. All right. Another, you have cash flow. Cash flow. Everyone loves cash flow. I guess in stocks and bonds, you'd call this dividends. But here, even though you have an asset that's constantly, it's appreciating and you're depreciating it, and over time, real estate's gone up year over year, 10, 11%, I think on average, you still get cash flow in your pocket, which is beautiful. And that's also, it's gonna be a big part of this course, just figuring out, your cash flow, your cash on cash, your return on your investment, different stuff. Number 5, or was that number 6? It's a real asset. Again, sort of like you control the asset. It's not like just up to somebody to, give a tweet. It can't just disappear. Nobody could hack it. It's a real building. It's not going anywhere. People always need housing. No matter what happens, you can bet that people will need housing. So therefore, real estate, at least multifamily real estate, will always be there, and Amazon will try, and they'll probably, I guess Zillow is the Amazon of real estate, but I think they're stepping back from buying houses. I think owned by Zillow was like a big thing. Now it's like they're stepping back a bit. So beautiful. 1031 exchange. I'm sure 3/4 of people know this, but for the few who don't, this is an interesting thing, is that whenever you sell an asset, you have a capital gains expense. You have a capital gains tax. And Gurv can tell you it can run from 15, 20, 25%. So imagine you work your ass off and you make 100 grand on something, in profit, you sell it, and there goes 25 grand. That sucks. So 1031 exchange means that it's very specific, the criteria, and I'll go over it very briefly now. Essentially, you sell a property, you have 45 days to locate 3 other, could be 1 out of 3 other investment properties. So within 45 days, you could point to 3 different deals. I want to buy this one, this one, or this one. And then after those 45 days, you have a total of 120 days to close. And then you could avoid paying the capital gains if you bought something for the equal to the sale price or greater. So if you're selling a property right now, I'm selling a property for 1.9. I have to buy something for 1.9 or greater, or else we have to pay a lot of capital gains. Refinance. So where else do you see this in investing? Del Vogel raised the hand. This is fun.
Just quick question. Let's say all 3 of those properties fall through, but you find something else after the 45 days. What happens?
You can't. You're done. Within you have to pay Big Sam.
Fair enough. Okay.
Yeah.
Thanks.
Yeah. So I was speaking to a 1031 exchange. They're called the qualified intermediary. That's what they're called. So the qualified intermediary was saying you could point to more than 3 properties. Like, let's say you sell the building, you want to buy a bunch of single families, you can buy 5, 6, 7, as long as it's not 200% of the sale price. So if you sold something for 2 million, you can't exceed 4 million of the total purchase. Okay, refinance. Back to this. Refinance is where if you have a house, you have a lot of equity in the house, you have a lot of ownership in the house, and now you could actually tap into that via refinance. So you still have the asset, you still own it. All of a sudden, you get a chunk of change to your pocket if you bought right and you managed right, and that's actually tax-free because it's a loan, so they can't tax it. And refinancing is the best because it's just money to your pocket and they can't tax it. It's delicious.
Sorry, can I ask one more question?
Yeah, Doug.
Just about the 1031, just before we move on, it's popped into my head. With the 1031 exchange, let's just go with your analysis of the you have to pay 25K capital gains. How much of your sale value do you have to put into the new property? Is it the 25K, or does it have to be all of it? Does it have to be none of it?
It has
How
to
much
be
of that do you have to
whatever
put
you
in?
sold for. So if you sold for 2 million, you need to buy another asset. It can be more than one asset, but the total assets that you locate and that you end up buying, you have to be equal to the sale
But
price.
you don't have to
or
use
greater.
the same. You don't have to use the same money. Doesn't make sense.
No, you could add money to it. Like let's say, so of that 2 million, it's not all profit, right? You're paying back the banks.
Of course.
You're paying back,
Got it.
it's not all profit. Let's say now you have
Yeah.
500K profit. You could now leverage that 500K profit and buy, the $2 million property. Or you could add, you could now go back to the investor, say, hey buddy, I just made you 2x on your money. Let's go right back and let's get a bigger property. Let's roll up, let's scale up, which is delicious. Nowadays, I don't know, it's so rough. I don't know. I haven't seen anything interesting in a while, but let's see. There's very creative methods to always buy stuff. So I don't think there's ever really a bad time to buy. And we'll go through some of those. Okay, so that's refinance. And then LLC asset protection. You have your investment and it's actually protected that if anybody tries to sue you and anybody tries to mess with you, it's in its own company. Tell me if I'm wrong. I don't know. Can you do that with stocks, with bonds, with any other stuff to like just stick it into its own company that it's its own, offshore account kind of? I don't know. Maybe. I don't actually know, but I think that's true. I think this is specific to real estate, which is great. Okay. Good. Basic term, basic stuff. Common misconceptions. 1, you need a lot of money. You don't need a lot of money. You need to know how, and you need to have a little bit of balls, and you just find deals. You hunt, and there's always more people with money than deals. So somebody, so how do I find somebody? I don't know anybody, a doctor, a lawyer, you have an uncle, you have a friend, you have this. If you have a decent deal, maybe the first 1 or 2 deals, nobody's going to want to back you because, you have no track record. But if you did 2-3 deals and you bought a property and you were able to up the value, we'll go through exactly what that means. You're able to refinance and pay them back. They're very happy. You'll have people coming to you to give you money. So you do not need a lot of money. You do not need a license to be a real estate investor. To be a broker or property manager, you have to be licensed. It's weird. To be a property manager, at least in Connecticut, you have to be a licensed real estate agent, which doesn't make any sense to me. Because in order to, oversee a plumber changing a toilet, you have to be able to also rent houses and apartments. 3, need to be polished. You don't need to be polished. I think you need to be, I think there's the investors that come all polished and they like to be hands off and then they get screwed. Or you have like the people like in Connecticut, you see a lot of them. They're like, these like middle class-ish to the upper end of society, and they're kicking butt. And need connections. You need to build connections. You need to be on all the chats. I love Facebook. You meet a lot of people on Facebook. I love all our real estate WhatsApp chats. They're great. These are your connections. The world is very connected. Okay. Term sheet. We're going to run through these. So where are people holding? Like, is this super obvious so far to everyone? Because I don't know. I want to gauge it for a second. It's all pretty basic, right?
Good, it's good stuff.
Right.
A lot of this stuff I know about, but I also don't know like the details of like what it would take like to actually get something like that started. Who would you reach out to? Like
Right.
going into more details of by is it 1039? Would my basic accountant do that? Like
Yeah. So
going into a lot
1031,
of
yeah,
stuff
it's
I
interesting.
know, but,
Like,
like,
there's
now that I know about it, what do you do about it? So maybe getting into like more detail or something like that.
yeah. So there's 100%. We definitely will. Certain things like most of these terms. So I have like the term sheets, like the menu, and then throughout the PowerPoint, I'll say like, okay, what is, appraisal? What does it mean to have an appraisal and pay off the old loan? And why not? And you're left with money, and what do you do with it? And, you have a capital account. So, like we highlight that, or cap rate. I love talking about cap rate. We're going to get into it. We're going to give different things. We're going to, And then once we know these basic terms, we'll go through the sheet and everything will be very easy to understand. Yeah, so like you're saying with 1031, right? The specific details we shall talk some more about it. Okay, so terms to know. Proforma means a marketing brochure, right? Somebody gives a proforma, or it's like the expected value. So on a marketing brochure, like you hit up a broker, right? How do you get deals in the first place? So you can always look, you go on Zillow, you go on LoopNet. For commercial deals, you're looking on LoopNet, you're looking on Crexi. What I like to do is also I signed up to all the big players in Connecticut to their marketing lists. So they're just pounding you with deals all day, and most of them are shit. Every once in a while you find a decent deal, you see it's 75 a door, 80 a door. And then you like zone in on that. You like text, you message her back, like send me more details. And then she sends you a performance. She sends you a spreadsheet. And that's what we actually have on the sheet. I imported one to the Google sheet. And that's what we're going to break down. We have a deal that we're going to run through that, that she sent me. So that's what a proforma is. Proforma is this spreadsheet that she sends you. So it's the marketing brochure, or it's the expected value. So they also say like proforma value, or like whatever, like proforma rent. They'll say, current rent, this is how the rent roll is now. And this is proforma rent, what it should be. So you have to be very careful on these marketing brochures, because a lot of times they're going to just sell you the expected value as if it's what's already happening. So 90% of the time you have to really, yeah, you gotta.
Would normally be sent only in commercial, like they're selling 10, 12, 15 units at a time, correct?
No. There's always a proforma, like whatever on Zillow. You're
Single
not gonna have a
family,
proforma really.
You can ask for performance.
Yeah, it's you're
More
right.
commercial, dear.
Yeah, and when anyone could have a proforma, it just like it means your breakdown. I'll show you one. Let me see. Let me pull one up.
Will you go into details of making a performa sheet as well on our own?
Yeah.
Okay.
Yeah, I have one where I'll show you. It's a different software that I use. It's like just a different spreadsheet. That's like one sheet instead of, you don't want to send an investor 10 different columns and try to tell them how to work it. So I have a different software. It's a lot quicker to use. It's a lot cleaner. You just have two columns, like what it is, what it will be. Maybe you write some notes on the side. This is what she sent me. I threw this picture in here just so it's good to have an image in front of you while you think about it. But this is a proforma. Okay, we're gonna speak more about it. The sales price, the loan amount, the LTV, the term, interest rate. She has basic expenses here. She's missing a lot of expenses, or they're just underplayed a little bit. So this is what we're gonna go through. Let me go back to this term sheet. Yeah. So two things. Proforma means the brochure means like the expected value. Vacancy rate. Whenever you have a property, even if it's 100% occupied when you buy it, you buy a 6 unit, everyone's living there, you still have to calculate a vacancy rate. Okay. Sometimes on these small single families, you do a lesser one because hopefully you get a 10, they stay there for 10 years. There's lower vacancy rates, or it's a good area. You have something in East Rock, you have something in a nice downtown Dumbo area. It's going to have a lot lower vacancy rate if it's not priced too high. But always you have to calculate a vacancy rate. So even if, the rent monthly is, 10 grand and you have a 5% vacancy rate, you have to assume that monthly you're losing $500 because one of these months it's going to be vacant. Somebody's going to move out, and then you're going to have to renovate it, and you're going to have to find a new tenant. You're going to have to hire enough Sully Kaplan to rent you out an apartment. And then it's going to take time because I'll tell you, it takes a lot of time renting his apartments. I'm kidding. I'm just talking shit. I'm just kidding.
Market, yeah.
Yeah. So that's vacancy rate. This is what it is. And usually on residential, it's a 5%. On commercial, it's 10%. Okay. When I say commercial, I mean like storefronts, commercial office, they usually calculate a 10% vacancy rate. On residential, they usually calculate 5%. Now, this is just a random number. This 5%, this 10% is just a random number. So if you really want to tighten up your deal, you want to look at the historic vacancy rates. You want to see, if it's a building that's really, has a good reputation and it's priced fairly, it's going to have a very low vacancy rate, even if the whole area has a 10% vacancy rate. So, there's going to be standards. Your standard broker is going to give you at a 5%, but obviously when you get into your deal, especially the bigger deal, you want to really crack it down. Okay. That's vacancy rate. Net income. Net income is you have the gross income. Exactly like we said before, you have the 10,000, you have 10 apartments, renting at $1,000 a month, you have 10,000. The net income is the income that's coming in after. I believe that's with all the income. So that's the gross income, take off the vacancy rate with the laundry and the parking and everything. Amazing. Net operating income is called NOI. We're going to hear this word a lot. NOI, NOI, NOI. Net operating income. Net operating income is the net income, right? Your income that you're getting every month. Take out, your gross income, take out the vacancy rate. That's your net income. Then take out all the expenses. Once you have this number, that's called NOI. This is the gross income minus the vacancy rate minus the expenses. You're left with your net operating income. This is what we're expecting you to actually get every month. But don't forget, it's not counting the debt service. The debt service is what you owe the bank. Okay. So monthly, you're also going to have your mortgage payments, unless you bought it cash. Now this money, what you're left with after that, so your net operating income, then take off your debt service, take off your fancy word for mortgage payment. That is now that's going to be your cash flow. That's actually what you're cash flowing into your pocket. Now, obviously, if you bought it cash, then also that's cash flow to your pocket. So delicious, but that's debt service. Debt service is just the mortgage payments. NOI, everyone knows what NOI is. It's the net income minus the expenses. We're gonna have it a lot.
Is taxes in NOI, or is that debt services?
So taxes goes under expenses. Taxes, insurance, water, sewer, electric.
Debt services is strictly
Mortgage.
mortgage? Okay.
Exactly. Debt service is
Okay.
strictly mortgage. So your NOI is minusing all the expenses. Then you have debt service. Okay, now you have DSCR, which is debt service coverage ratio, which is just a good ratio that the banks look at. Like everyone has their ratio, you know. An investor is going to look at the return on investment. He's looking at his cash on cash. He's going to look at the cap rate. The banks love debt service coverage ratio, which means how much net operating income do you have to debt service? So if you are making 10,000 a month, right? That's profit. 10,000 after expenses, 10,000, and then your mortgage payments are 5,000. So now you have a 2.0 debt service. You're 2 times the debt service. Your NOI, net operating income, is 2 times the debt service. That's excellent. Banks stop. They require 1.25. Basically, be making the mortgage payments plus 25%. But you know, you want to be at 1.5, 1.6, 1.7. So you guys understood that? So if you have $10,000 in net operating income, that means you have the gross income minus the vacancy rate minus the expenses. Then you're left a net operating income. If this is 10,000 and the debt service, the mortgage payments are 5,000, now you have a debt service coverage ratio of 2.0. Amazing. Okay. Again, we're gonna go through all these things in the PowerPoint, but you know, we'll go over it now a bit, and we'll you know, be more familiar with it when that comes up. Amortization. Who knows what amortization is?
Amortization is how it goes down. Isn't that like how your loan slowly goes down? Like
Yeah.
On the loan.
your interest compared to your principal, how much you.
Right. Exactly. It's just so amortized means like it's like the length of the loan. It's a loan that's you're not paying up in one chunk. It's split over 30 years, 20 years, 25 years. Typically, it's 30 years. On commercial, it's sometimes 25 years. Your amortization is when you have your loan. So thank God we're able to now split it out over 3 years, amortize it over 30 years, and therefore your monthly payments are a lot less. So you could really leverage the banks. If you have to pay it back in 1 year, your monthly payment would be 1/12 of your whole loan. That would kill you. So now it's 1/12 divided by 30. So whatever the hell that is, but it's a lot less times the interest rate. You also have to pay the interest, obviously. But that's amortization. And like Naftali was saying, it's you look at the classic graph, it goes, so the payment stays the same throughout. That's also what they like to do. They don't want to have it that as you're paying down your loan, you have less of a loan balance. Therefore, you should pay less money monthly, right? Then every month you'd have to calculate your mortgage payments and you'd have to send it in. So what they
Yeah.
do is they have the exact same payment every month. The way that they do that is in the beginning, you're paying a lot more interest. You're paying 3/4 interest to 1/4 principal. So if you're paying $1,000, 750 of that, yes, good math, 750 of that is interest and 250 of that is principal. So they're doing it for you to make it that you don't have to calculate your payments every month, but they're also doing it because now your payments every month are almost 75% interest. So if you then get a different loan, you barely paid off any principal, even though you had the same mortgage payments going the whole time. So the bastards love to get you. But that's amortization. Does that make sense? It's the same payment throughout. The way they do that is that in the beginning, you have a lot of interest and a little bit of principal. And then as it goes, so you're doing a lot less interest payments, but you're doing a lot more principal payments. So they make it coincide perfectly with their calculators, exactly what your mortgage has to be to make it flat, to make it the exact same payment throughout. So yeah, if you paid off your loan for 5 years, get all excited, but don't get so excited because 75% of that was interest. And as you go, obviously it gets more. Now 70% is interest and 30% is principal. And then it goes, principal means paying down the loan itself, interest means paying off the interest. Okay. That is amortization. Comps, comparable sales. Whenever you are looking to buy a property, how do you know the value of the property? So there's a few things that they look at. So part of it is comps. So if a house nearby, the exact same size, exact same amenities, the exact same year or similar, or similar condition, sold for 300, you can't expect to now get a loan for 400. The bank's going to say you're paying too much. I'm not risking our money for you to be an idiot and overpay. So you have to make sure that your comps, that your comparable sales are in the same area. And that's how you really determine a value, especially of residential property. 1 to 3 units is residential. 4 and above is considered commercial. Sorry, 1 to 4 is residential. 5 and above is now commercial. So residential, for sure, they go off comps. They almost don't look at the operations. They don't look at the cash flow. They don't look at that at all, really. They basically just look at similar houses that sold within the past 6 months, within a half mile to a mile. But once you hit that 5-point mark, they really start looking at the actual value that you are producing. So we'll go through that, how to calculate that.
Where do you find your comps?
So Zillow's great. You go to Zillow, go to sold. Then you could make a map. You could I think on Zillow you could draw a map within Beaver Hills, within Crown Heights, within whatever. And then you could put in 3-bed, give or take. I use a software called Batch Leads, which I pay $100 a month for. So that's great. It's not bad. And Batch Leads gives you, I'll go through it a bit later. It gives you like tons of information about what they bought it for, what they owe on it. It tells you the property taxes in one shot, like accurate stuff, pretty accurate. And if you pay 5 cents or 10 cents, depending on your account, it gives you like their phone number. So a lot of what I do is I don't look for deals on Zillow. I hunt for deals. So I'll like put on a whole filter of different deals of different like houses. Let's say the owner owned it for 30 years or whatever. I'm getting way sidetracked now. We're talking about comps, but I'm going to need this also every once in a while. We'll have a point person who says, get back to it. Okay. But I'll show you some cool resources. Just because how they say like all the information's out there, but it took me a freaking long time how to like figure out, exactly what that means. How do I know what somebody bought something for, what they owe on it, whatever, how big their lot is, But everything's public, so let's get it and let's figure out what we should pay for it. So that's comps. And Batchley is very good at comping. Okay, cap rate. So cap rate is, it's the NOI divided by sales price. So the net operating income, whatever income you get, divided by how much you paid for the place, that's your cap rate. It sounds very similar right now to return on investment. So if I paid $1 million for something, and this I really have like spreadsheets, and we'll go through it, because cap rate you need at many times in the transaction. You need a cap rate when you're buying, when you're selling, when you're refinancing, and it kind of flips its purpose. Sometimes you want a high cap rate, sometimes you want a low cap rate, depending if you're buying or selling. But this is what your cap rate is. This is how you calculate it. It's your net operating income. So let's say 100,000 divided by 1 million is 10%. Your cap rate is 10%. And we're going to go more in depth on cap rate. So cash on cash return, ROI, return on investment. It's similar, not the same. So cash on cash and ROI are similar to each other. Cash on cash really just looks at cash out of your pocket to cash into your pocket. It just looks to see if I spent $100,000 and I got back $10,000, it's a 10% cash on cash. ROI takes into account
Annually, is that annually or
Yeah.
monthly?
annual,
Annual, okay.
annual, yeah. All like return on investments are all annual.
Okay,
So that's a 10% return on your investment annually. ROI, return on investment, takes into account more in depth, the property went up, you paid down some of your mortgage, like think about it, every month I'm paying 25% of my mortgage payment is going down to paying down my loan. So technically it's not all going to the garbage. So even though I made $10,000 this year, but really I paid off, let's say $5,000 in my loan. So I made 15,000. So ROI would take that into account. Cash and cash really just cares about that. Wholesaling was a very interesting business. It still kind of is. I'm like, I don't know if it's like, I do it a bit. Wholesaling is when you get a property and you don't actually close on it. You just lock up the contract. So if somebody's selling a house for $100,000, you say, I'm going to buy it. And you get a contract, and now he is beholden to you. And now you promptly turn around. It's a pretty shitty thing to do, I think, now that I'm saying it out loud. But you then turn to somebody else and you give him the contract. You assign him the contract. That's what it's called. You assign it to him, and now he buys it for 120. So you made 20 grand without doing anything. So this isn't like flipping. This isn't like rehabbing anything. This is you're locking up a contract, and now you're flipping it to somebody else. That's called wholesaling.
Beautiful money right there.
It's amazing money. Yeah, it's the easiest. It's not easy because like this shit falls apart so fast, so often. Like you had a buyer, and then you had a seller, and then the buyer ghosted you last minute, and now the seller's getting pissed. You're like managing like 3 different parties, 2 different parties. But
They're a little get sticky at the closing sometimes when they find out how much money you made.
yeah, it gets weird. And then also like you really want a cash buyer, because so like let's say now I'm flipping the contract to David for 120. Now David wants to get a mortgage on it. The bank's not about to give me a $20,000 commission. The bank doesn't know who I am. So you really want to make sure David's a cash buyer. He signs a contract with me, an assignment contract for cash, and then then I get my assignment fee. That's wholesaling. We're gonna go into the bit. This is where I use batch leads a lot to find people's numbers. I get massive lists, and I start calling them, and I text them, and I harass them, and I nudge them, and I become their friends. Also, that's when you close, is when you actually become their friend, and you chill. And I've done about 6 or 7 wholesales. So the ones that we actually close are we had a very good time throughout. Some had to fall out of like 2 or 3 that had to fall apart, and those were like whatever, like it was bad blood, obviously, and that wasn't great. But for the most part, it doesn't have to be, like you're giving someone value for what they, for what they have. Earnest money deposit. When you start and you get a property, you have to put down. You get a contract, you give them earnest money deposit, you give them a deposit. Appraisal is you always, whenever you buy something, if I'm using a bank, the bank needs to do an appraisal. They want to make sure that this house is taka worth what you're buying it for. BRRRR stands for buy, reno, rent, refi, repeat. I love this method. It's a little bit harder now because interest rates are just crazy. But essentially what you do is you buy a property with a hard money loan. We're gonna get into that a bit. Hard money loan, you put down like 10%, and they give you all the construction costs. And let's say you got a really good deal. So if you bought a property for 100,000, but really it's worth 200,000, right? You hunted, you found that one old lady who wanted to get rid of her house no matter what. She lives in Florida. She has squatters. You say, I don't care. I'll get rid of the squatters. You buy the house for 100,000. You pay off the squatters. They leave. You renovate the place. Now you do you buy it. You rent it, right? You get somebody else in it. Now you refi. Now when you're refinancing, all of a sudden your 100,000 that you paid for, you put in 20,000. It's worth 200,000. So you now could refinance, you get out 75% of this 200,000, which is 150. You pay off the 100, you pay off the 20, you pocket 30, and now you have a property paying you money. That's why you repeat, because the money you put into it, you're not waiting 10 years. You're not waiting for a 10% return investment to get it out. You turn around and you do it again. And it's very easy because they only normally hard money, lenders normally just require 10% down. So if you're buying something for 100,000, it's quite simple to pull up, scrape together 10 grand. And then, 3 months later, you get back that 10 grand plus 20 grand. And now you have the money to repeat. So BRRRR is nice. The issue is that it takes time to really stabilize a property. So you're buying a 10 unit, it takes time. Interest rates, you're getting killed with interest because it's very high interest. I'm paying now like 8.25, which that is basically where regular interest rates are holding now anyway, so it doesn't matter. But
No, good rate.
8.25 is not bad for hard money, huh? So
Very good.
we're paying 8.25, and now when you refi, the interest rates are already at 7. So it's a little bit tough to try to buy such a value add play. We'll get into it.
Yeah. Are you gonna go into like more details like on a lot of these points?
Yeah.
Okay.
Yeah, because I'll tell you what, these throughout our sheet, we're going to keep on having these terms come up a million times. So that's why we're going to, I want to just go over it
All
nicely
these are
now.
gonna go into like greater detail?
Yeah, like I'll show you real quick. Like let me escape. Let me see. Net operating income, net income on expense. We'll talk about cap rate. Cap rate is NOI purchase price. Understanding cap rate, where to use it, then this, and now sorry, where's we're gonna really go through cap rate over here to see how, whatever, we'll go into it. I'll show you what we're gonna do with it.
Got it.
But yeah, we're gonna go through the stuff.
Would love to go into more details on hard money loans.
Yeah,
Of
definitely.
like just what are like the requirements of like payback, of like how long,
Yeah.
what you pay back early, or is it worth it to pay back early? How long is there usually loan for? 6 months, a year?
Yeah. So
Going into some of those details of like the really dissecting that of
Yeah,
if I
definitely.
can get one, but how does it actually work on a day-to-day? I was to get one tomorrow, what would be their
You should get one tomorrow. If you have a deal, okay,
Okay,
so we're gonna get into a bit because
yeah,
essentially you need to buy something that all in, when I say all in, I mean the purchase price plus whatever construction, whatever renovation you have to do, all in, purchase plus the construction, you want it to be 75% of the ARV, the after repair value. So after you repair it, right? Remember I told you my muscle, the house that had squatters. I bought it for 100,000. I put in 25,000 or 20,000, and when I say 20,000, I mean 15,000 for the repairs and 5,000 for getting rid of the squatters, between eviction and, just cash for keys. So your all in has to be 75% of the new value, of the appraised value, of the market value. So you can't just do hard money on any loan. Why does it have to be that? Because think about it. When you're looking to refinance now, when you're on the tail end of the deal, right? You bought the deal hard money, but now you want to get a regular bank, conventional financing, the bank's only going to give you up to 75% of the 200. So what's 75% of 200? 150. You understand? So all in, you have to be max 150. If
Got
you
it.
were all of a sudden all in, if you bought for 125 and you put in 50, so you're all in 175, but then you only appraise for 200, now you're out of pocket 25K. You know, maybe you can't afford that. Maybe you don't have them. You know, this is also a small scale. What if we did this with $1 million? You know, the 10% was
Yeah.
100,000, you know? So all in, you got to make sure that your purchase plus renovation plus whatever time you're into it, you want to make sure it's max 75% of the ARV. And we'll get into that as well. Details about hard money. Hard money is awesome because they close super fast. They don't underwrite you for shit. They don't want to see tax returns. They don't want to see anything. They just want to see the property. They want to do their appraisal. They want to make their points, right? Usually you pay them 2-3 points, like just upfront costs. Let's say 1 in, 1 out. That means 1 when you get the deal, 1 when you pay off the deal. They typically range from a year to 1.5 years. I haven't seen any less than a year. Rates, when I was looking, they were 8.25. I'm sure they've gone up a bit. Also, they're variable rates, a lot of them. So you got to make sure, because a lot of them, there's an index on the Wall Street Journal, and they do like the index plus 8 points, you know, whatever. So you got to just keep an eye on that. But if you're going to be quick about it, like let's say you don't have to get rid of somebody. If you have a vacant house, it's going to take you 3 months to renovate. You're getting all the construction costs. It's the cheapest. It's the easiest money you're going to get. Like sometimes it doesn't even matter if it's expensive money. If you're out of it super fast, then who cares? You're not paying 8.25 for the whole year. You're whatever. Does anyone like this make sense?
Yes, of course.
Okay, awesome. Cool. All right, let's carry on. P&I stands for principal and interest. Just back to debt service. When you're paying your mortgage payments, part of its principal, part of its interest. I'm sorry, it's not so 100% organized. I was doing it mostly as I was going through the sheet. I was like just taking, you know, different terms that I thought might not be day to day. It's P&I stands for principal and interest. Every time you have a mortgage payment, you have the principal payment, which, like I said, is a lot lower in the beginning, and then you have the interest payment. Sometimes you get a IO loan, which stands for interest only. Interest only is great. A lot of times these hard money loans are also interest only. So like, let's say you don't have a lot of cash flow, you want more cash flow, so you just pay off interest in the beginning, and then you're good. Not, you know, you just have more cash flow, you have more money to work with on the month to month. I don't care to pay off my loan right in the beginning. I want to make sure I have money to pay my tax bills and to pay my water bills. I'm not looking to pay off my loan just yet. P&L stands for profit and loss. It's the P&L sheet. So every year you have the profit and loss, and on our sheet as well, we're going to have one of the tabs is going to be the profit and loss, right? The profit, whatever you gained, the loss, you know, is that what it stands for? It might be profit, either you gained or loss, or you've lost. I don't know. Or it's like profit, income, loss, expenses. One of those. Maybe someone who knows more accounting could tell me. That's P&L. LTV, loan to value. Loan to value is the max that the bank will lend you on your deal. So if, like we're saying now, you're buying something for 100,000, the bank's max LTV is 75%. That means that the bank's giving you 75,000, and you have to come up with 25% LTV, not LTV. You have to come up with 25%.
The member manager equity. I didn't hear that one.
I did miss that. Okay. This is more getting into just like equity and okay, member manager equity. Whenever you have a deal and you have investors, we're going to go through a bunch of different splits, because at the end of the day, nothing's cookie cutter. There's no way that you're going to split with an investor, but the manager essentially is the guy who's operating the deal. He's the syndicator. He puts together the deal. He's the manager of the deal. And then you have the member. You have like the different members. They're I don't know. They're silent partners. So that's the member manager equity, and we're going to show it down on the sheet as well. So I took it from there. Thank you for that. Profit and loss, P&L, loan to value, LTV. Like I said, 75%. That's pretty common. 75%, 80% is, you know, a lot. If you get an FHA loan, a Federal Housing Administration loan, sometimes you only have to put down 3.5%. And they put down all of it. So different LTVs, different loans, range, usually commercial, it's like 70 max, 65 even. Capital account is the capital that you still owe to your investors. So if you got $100,000 loan from your investor to make up the down payment, right? Let's bring it back to our example. You have $100,000 property that you're buying, you have to put up 25%. So it's 25K. I don't have 25K. I get an investor. He puts up the 25K. That's his capital account. As I pay him down, now depending on how you set it up with your investor in the beginning, you're paying down the capital account. So either cash flow will be considered paying you down, or either only capital transactions like a refi or a sale. That's capital account. Exit strategies is different exit strategies to a deal. You need multiple. Whenever you buy a property, you can't just rely on one execution of your strategy, right? I can't say I'm going to buy this property and then rent it out till Mashiach comes, because what if you have to move to Louisiana? What if whatever the hell happens, what if you're not covering your ass and you need to sell? What if interest rates go up so high and now you can't hold it anymore for the price you bought it? So you need to sell. So that's another exit strategy. So you have to refinance, you have to sell. With houses, I have a buddy, he's doing flipping right now around Connecticut. So he is a flipper. He buys a property, takes out a bunch of loans on it, and then his plan is to sell. But right now, rates just went sky high and he's having a hard time selling some of his houses. So he's like, okay, I'm gonna have to rent it, or I'm gonna Airbnb it, or I'm going to rent to lease. There's like rent, lease to own. That's what they say. Lease to own. You get a tenant, he's leasing it, but he's really paying down your payments. Different exit strategies. Refinance. So financing is when you have a loan on a property. Refinance is when you get a new loan. So I had a loan like we were talking about before with the Burr method, buy, rent, reno, the hard money method. You have one loan that's super high interest and it's only for a year, and after a year they're going to start charging you points up your ass. So you need to refinance, you need to get a new loan. Hopefully if you executed right, there's enough to pay off the old loan and there's still more going around to put in your pocket, your investors' pockets, and you still get a cash flowing property. And then last but not least is after repair value. And I'm sure there's a million more terms. This is just what I pulled through the spreadsheet. PMI stands for property mortgage insurance. Usually if you ever have a property that you put down less than 20% LTV, if you put down less than 20% of the property, the bank is at risk. Why are they at risk? Because you have less skin in the game. So anything less than 20%, it's like a law. I don't know if it's a law or it's just what banks do. Anything less than 20%, banks usually charge you PMI, and it's a certain percentage of your loan. I don't know how they calculate it. Sometimes I think they just make it up, but it's money going to the garbage. So you want to quickly, either whatever, some loans you could put down under 3.5% and there's no PMI. Like in Beaver Hills just now around New Haven, Liberty Bank was giving out a loan that was only 3% down. That's peanuts. And there was no PMI, which was awesome. But generally like regular FHA, if you have an FHA loan and you go under 20%, they're going
One way to fix that is to get another appraisal after you buy it.
Right.
In other words, once you're in contract, you can inflate that and it goes below 20% because your LTV is high on the appraised value. Just something to note.
Cool. So it's like you have 20% equity in the property already. Like if you got a great deal, it's like, let's say it's worth 100, 200 grand, like Tel is saying it's worth more, and you get another appraisal and they prove that it's worth more and you only got it for 100. So really you have more equity in the property, and your equity is more than 20%. So they stop you from paying it. Sweet. Hell yeah. Okay, let's carry on. People are good with these terms, basics, we're good. I think it's great to go super slow, because then when it comes to the sheet, we don't have people scratching their heads like, oh, NOI, net operating income. I know what that is. We spoke about it for 5 minutes. It's when you have the gross income, take out the vacancy rate, take out the expenses. That's what you're left with. You're left with this, but remember, it's before the mortgage payments. Okay, let's carry on. Why is this frozen? Amazing. Net operating income. NOI is the net income minus expenses, right? You have your income minus expenses. We know what that is, correct? Awesome. Cap rate. Cap rate equals NOI divided by purchase price. And let's see what that means a little bit more. Understanding cap rate. You guys with me still, by the way?
Yep.
It's so disconcerting. It's like, I like the thumbs up. Thanks. It's so disconcerting because it's like everyone's muted. You can't hear a word. You don't know if it froze, and for a half hour you're just talking to yourself. But it's good. Yeah. Good times. Okay. Understanding cap rates. A cap rate is the return on the purchase price, right? If I buy for $1 million and I get back 100,000, that's 10%. Now, cap rate will also help you determine what to offer. Okay. We're going to go through examples of that on the spreadsheet so you'll know. But essentially, how do you know what to offer on a property? Because they're trying to sell it for $1 million. It's worth $1 million. No, that's bullshit. You need to do your math. You need to do your homework. You need to figure out what the property is worth. How do you do that? You have to first determine. Okay, so what do you do? So you have to first figure out your NOI, to figure out what the building's producing. And then you have to figure out the cap rate. And that will tell you what to offer. It's a little confusing.
I have a question on that.
Yeah.
When you're looking at a deal, I know you can like estimate basic house expenses and things like that. Is there like a more accurate way of actually finding out what the house expense would be from just looking at a deal from the outside? If I'm looking at Zillow, if I'm looking on MLS, if I'm looking on something, is there a way to see a house and like?
Yeah, there is. That's so this period, when you get into contract, you have a period called the due diligence period. So your deposit is protected a few different times, depending on whatever you negotiate in your contract. So you put in a $10,000 deposit, you want it to be protected until you see the property, until you really get into the nuts and bolts of it. That's the due diligence period. Let's say standard closings, let's say 60 days. So 10 days or 2 weeks, 14 days will be the due diligence period. So your deposit will be protected for 14 of those 60 days, no matter what. I could come back, say, oh, I don't like the paint color. You should have told me that before you went into contract. I didn't realize. That's due diligence period.
And are you putting that in when you're putting an offer? Is that you'll write 2 weeks for due diligence? That's separate to inspection?
It's
or
the
was
same
that fall
thing.
under inspection?
It's the same thing. It's inspection. It's whatever you negotiate. Inspection, we're calling due diligence right now.
Okay.
Yeah. So you have the inspection period. That's the due diligence period. Now, usually during due diligence, there is any reason to back out. After that, the next 30 days, so 45 days in, let's say, will be covered under a mortgage contingency. So you have a contingency that says if I can't get a mortgage for whatever reason, then I could back out and get my deposit back, right? So if I'm trying to get a loan from the bank for $75,000 for this house, and I realize, oh shit, I have bad credit. I didn't realize. I could say, hey, look, I realistically tried. You have your lawyers, they draw up a document. I tried to get a loan. I couldn't get a loan. And now again, I get my money back. Now, obviously a seller doesn't have to take your offer if you do all these crazy terms. It depends if it's a seller's market or if it's a buyer's market. That will determine how much you could play. Like if it's a buyer's market, then you could say, I want an 80-day close and I want 3 weeks due diligence and I want ... Also, the bigger the property, the longer the due diligence, obviously. And commercial is usually a lot longer as well, like commercial spaces. Okay, so cap rate is the return on the purchase price, right? That's the most basic. You know what you bought it for. You bought it for $1 million. You got back 100,000. That's 10%. Cap rate will help you determine what to offer. It will also tell you what the value of the property is, right? That's what I'm saying. That's cap rate will help you determine what to offer. It will tell you what the value is, because math works that if you have two parts to any formula, it will tell you the third part. Okay. So if I have, let's go over here. Let's do it. Let's bite the bullet. Well, cap rate will help you determine the value, future value of the property, blah, blah, blah. Let's go over here for a second. So I have the three scenarios of cap rate. Let me zoom in a bit. Okay, you have three properties. 1, 2, 3, New Haven, Miami, New York City. The New Haven property you bought for $1 million. The Miami property, the properties are more valuable. You bought for 125. New York City you bought for 2 million. They're all three of them generating 100 grand. Okay, so very simply, if you paid $1 million and you got back 100,000, that's a 10% cap rate. That's a 10% return on investment. Okay, now why am I not saying return on investment? Why am I saying cap rate? This is something we have to know, is that cap rate is what you paid for the property and what the building's generating. It's not taking into account whatever financing you got. It's not taking into account any bank loans. It's before the bank loans will tell you your cap rate. And it's a valuable tool to have because it could instantly tell you if you got a good deal or not. Because think about it. If somebody paid a shit price, let's say this guy paid 3 million, but he's ecking out and he got the bank to lend him the whole thing. Or let's say he got a bank to lend the whole thing and he made $1. If he put no money in, $1 is, let's say he put in a penny, he got back $1, that's 1,000 times return on your investment. Maybe, yeah, or 100. It's 100 times returns on your investment because 1 penny to $1 is 100. So ROI, return on investment, takes into account exactly what left your pocket. Let's cash and cash ROI, what left your pocket to what you're getting back. Cap rate is talking a lot more about the deal itself. Did you get a good deal or not? And it sounds philosophical, but it's not, because you'll see that there's market cap rates, there's just fear cap rates to put in offers whenever you're buying a property. Okay, so before we get too philosophical, real quick, you paid $1 million, got back 100,000, it's a 10% return on your investment. If you paid 2 million and you only got back 100,000, that's a 5% return on your investment, right? If 1,250, you got back 100,000, that's an 8% return on your investment. That's very simple. That's the first way to look at it. Okay, so if, let's say I didn't know any of these, let's say this was 125, it's 1,250, but let's say it's 50. Great. Okay, now over here in this example, so the reason why I have to do it 3 times, I'm not Yakir Haven. I don't know how to do the formula, is that, so this has to be a formula. These two are, I could change the amounts to change the cap rate. But here, don't fuck with this guy because it's a formula. But let's talk about over here. Well, this is less important, but let's say I paid 900,000 for a property and I'm getting back a 10 cap. If I know what I paid and I know what I'm getting back, I know that's 10%, it means I got 90,000. Let's forget that for a minute. This is where I was talking to you about before, that cap rate helps you determine what to offer. Okay, so if I'm looking at a property in New Haven, okay, it's the city, New Haven. New Haven's a shitty area, relatively shitty area. Everybody in New Haven is high risk. High risk, high reward means that if you're putting in money, you want at least 10% return on your investment. So if you are investing in New Haven and each market has a cap rate, you're gonna have to determine the market's cap rate. What that means is that investors, let's say New Haven, are expecting 10% returns on investment. If you look on LoopNet and you take an average of all the deals, or if you speak to a big broker and you say, what's the average cap rate for New Haven? It's not actually 10%, it's a little bit less, but we're just going to use 10% for the example. Let's say the New Haven cap rate, the market cap rate is 10%. If the building is generating 200,000, right? You don't know this. You don't know this number. Blank out this number. Forget about this number in your head for a second. Cover it with your hands. I'm covering it, but it's not actually covering anything because it's technology. If you pay 200,000 and you want a 10% return on your investment, because that's what everyone's getting, the max you can offer is 2 million. So if I didn't know this, amount, but I knew what the building was generating and I knew what the market cap rate was, I know what I could offer. Does that make sense?
Yes.
In
Okay.
other words, the gold value is always the one that is the third part of the equation. Is that what you're saying?
Exactly. Yeah, exactly. Yeah. So over here in New York City, people aren't expecting 10 caps. Nobody's getting 10% return on their investments over there. Everyone in New York's getting 3, 4, maybe 5% returns. So a building in New York City generating the same amount as a building in New Haven is worth 2 million. It's very questionable. Why, if it's generating the same amount, is it worth different? And the answer, my friends, is because the cap rate. A building in New York generating 100,000 is worth more because, they're expecting the values to go up. Let's say New York has a higher, appreciation rate, or it's a better market, so it's less hands-on. It's, if you're dealing in a nicer area, you have nicer tenants. If you have nicer tenants, it's a lot more guaranteed that you're going to get that money. If you're dealing in New Haven, this 100,000 sounds like 100,000 on paper, but really it might be 90, it might be 75, because you're gonna have evictions, you're gonna have all this crap to deal with. So, sometimes 100 doesn't mean 100, but on paper, they're all generating the same. In New York, it's worth more because New York has a market cap rate of 5%. Miami isn't as good as New York. Miami's 8%. Therefore, your $100,000 NOI in Miami, you could offer
How
125.
shitty do you feel when you tell your investor you're gonna get him you're gonna get him a 10 cap, and then you have 3 evictions in the property, and you end up walking with like 6 cap or 5 cap?
Yeah. Listen, I
Yeah.
you live and you
Yeah.
learn, that's for sure, because I think, Double Abe's very into this. He's like, shitty areas, you think you're getting your golden returns. Proof is in the pudding. You look on LoopNet, we're the biggest cap rates in the whole Connecticut. The best deals in Connecticut are all in Waterbury. Waterbury has 13 caps, 18 caps, 20 caps, because nobody wants to buy there. Therefore, you have to have a really high cap rate to attract people there. It has to be a really cheap price in order to make it worth their while. Okay, so as in cheap price, $1 million for the same thing to make it worth their while, the 10%. Okay. Now over here, I want to point out to you that cap rate helps you determine what to offer, right? We just said what it tells you what to offer, right? So let's say the process of buying a deal. You get a marketing brochure from Lisa Kazi. She mails you a marketing brochure. Now you find out, you dig, you find out what the real NOI is, the real net operating income. You figure out what kind of returns you want to get, right? Also, you can't be ridiculous. Don't say I want 20% returns and offer her nothing, because then she's going to laugh at you and never send you deals again. So you have to figure out what, like, a fair market cap with a cap that you're happy with. You find that middle ground. That's what you determine what to offer. So this is another place where cap rate helps you. This is knowing that well is going to help us in the sheet a lot, because it's going to help us predict the future value of a property once we stabilize it, once we stabilize the asset. And that just simply means that if you have a 10-unit building and there's 3 people not paying and there's 2 vacants and there's 1 crackhead, you get rid of all the crackheads and you renovate the place and you up the value. That's what it means. Now, let me just show you down here. Was this all clear? David Grossman, was this clear?
Yeah, very clear.
Okay.
Trying to find the thumbs up emoji, but yes, it's clear.
Okay, dope. So all right, let's finish with this and then we'll stop here for tonight, and then tomorrow we'll get into the sheet a bit more. Sounds good?
Wednesday, no?
I was saying Monday, Tuesday for the
Okay,
next.
perfect.
Yeah. Wednesday, there's a different share, and Thursday's another share, and Friday's Shabbos, and Shabbos is Shabbos, and Sunday, I don't know, Monday, Tuesday, bang it out through the hump of the week.
I like it.
Yeah, baby. Okay, so let me just show you real quick, clearly, what happens when you raise the rent. Okay, so let's say I have a property and I raise the rent $50 a month, right? This is the monthly increase. This is the yearly increase. If I raise it $50, yearly, that's $600, right? So my property's not producing $600. Based on a 10 cap, that's $6,000 of value add. Now that sounds confusing, but remember what I just told you, that this yearly increase is the NOI, right? So let's find that. NOI divided by the cap rate, right? Imagine if this went up $600. The value of my property just went up to $1,006,000. That's based on a 10 cap. Now remember, decent years, like let's say New Haven's actually getting like 8 caps. So let's see what happens at an 8 cap. It actually went up more. So let me show you that. It went up more than 6,000 is what I'm trying to show you. Let's do it on the 2 million because it's clean. This 2 million, if it goes up $600 based on a 5 cap, what does it do to the property? It goes up 12 grand. By raising the rent $50, it raised the value in New York 12 grand. So in New Haven, where it's a higher cap rate. So now you're seeing something interesting here. The lower the cap rate, the higher the value. So you don't always want a high cap rate. If you're selling or if you're refinancing and you want to try to get the biggest value bang for buck, you want a really low cap rate. So you want your appraiser to come in and not say, oh, everyone here is getting 10 caps. I don't care if you have 100 grand NOI. You're only worth blah, blah, blah. Because everyone here is getting 10%. No. You got to fight him. You got to say, no, we're really getting 8%. Because the lower the cap rate, you see it raises the value to a greater extent. Now that was just $50 a month with one unit. That's not a lot of value add that you could have to a property. So like, let's say you had building properties are, $250 a month, and this guy was $100, and this guy was 175, and the rest were also 175. You raise your property, all of a sudden, this 10-unit property, you just raise it $210,000. And that, first of all, you're getting $21,000 a year in extra cash flow, and you have 200, and that's at a 10 cap. Let's do that right now again at an 8 cap for a second. No, that's not the right thing. 0.08. Let's do this. 0.08%. You just raise it 262,000. Now let's say it's Connecticut, New Haven, you could almost squeeze out a 7.5 cap, 280,000. So all of a sudden you're 250 here. So this is really a building that does have value add. So let's say you paid for this property. We'll do this on the sheets later, but let's say you paid for this property 700,000. And let's say now you're worth the 700 plus whatever you value added. Now you're worth 980. So now the
Sorry,
bank.
I'm just trying to understand. Are you saying you're increasing the rent by 250 every month?
Yeah, so that's a lot. That is a lot. But I'm talking like this one was 250, which yearly increase. But I'm not saying that you go to a guy and you increase it 250. I'm talking about like, let's say it was vacant, or let's say the guy left,
Right, but that would be once, no? Like if this is compounding factor, I'm trying to understand. That's 250 every single week, every single month for 12 months. It's increasing.
Yeah. But that raised the value of your property because now the bank always looks at the as is. The bank doesn't want to know pro forma. It doesn't want to know what it's gonna be. It doesn't want to know what it was. It wants to see what the hell's happening now. It wants to see leases. It wants to knock on doors and see the tenants are there. And it wants to see that you are actually getting these rents. They might even ask you to show some bank statements to show where you're getting the rents. But if as is right now, like you're saying once, it's 1 year, but who says the tenant's going to leave? The tenant's going to stay, whatever, they won't. But right now, the value of your building, the as is in place value just went up 280 grand. So now let's say again, you paid 700. Let's say you paid less. Let's say you paid 650. And now you raise the value by this 280. Equals this plus the 280. So you raise the value by this. So now appraiser comes in, he appraises you at 930, right? Now he's going to give you 75%. So he's going to give you 75% of this. This times 0.75. So he can give you 697. So now what do you do with the 697? You pay off the 650. whether it's partially yourself or investors. Let's say you can put a penny of this in. Let's say 75% of this was the bank. Let's say 25% were investors. So now you take this minus this, and you're left with 50 grand plus a building. So this is a tax-free income, which is lovely. Plus you have a building that's hopefully cash flowing, unless you're over leveraged if you know, went in too much. But that's going to be it for now. Thank you all for joining. You definitely can ask questions.
That was awesome.
Yeah, I enjoyed.
That's awesome. Thanks.
All right, take care, Chevra.
Thank you.
If you're, feel free to I could send this all so you can poke around at it. If you guys want to see, you guys can start poking around at the sheet. And we'll reconvene tomorrow, 7:30.
All right,
Thank
awesome.
you.
Peace,
Thank
guys.
you.
Thank you.
If there's any questions, we'll stick around for another minute, or if anyone just wants to chill. What's up, Gerv?
I was waiting for it. You might want to hit stop recording, bro.
Oh shit.
Yeah,
How do you even do that?
I had a feeling that would happen.
How do you even do that?
You know, technology be crazy, huh?
Shit. I saw the button somewhere, bro. The button was somewhere. First of all, stop screen share. That's for sure what you do. You stop share. I'm back, and then you